Okay, I want you to picture two people. Same age, same income, same starting point, $50,000 saved up, and a decision to make. Person A takes that $50,000 and puts it toward a down payment on a rental property. They close on a $250,000 house. They become a landlord. They tell everyone at the family dinner that real estate is how you build real wealth. Tangible, physical, something you can actually touch. Person B takes that same $50,000 and puts it into a low-cost index fund tracking the S&P 500. No tenants, no maintenance calls at 11 p.m., no property taxes, just a brokerage account and a long-term mindset. 20 years later, who won? If you answered person A without hesitating, you're in the majority. And you might be wrong, but if you answered person B with total confidence, you might also be missing something important. Because here's the thing, this debate, real estate versus stocks, is one of the most emotionally charged conversations in personal finance. And that's emotionally charged because both sides have real data, real winners, and real cautionary tales. The answer isn't as clean as the internet wants it to be. Today I'm going to walk you through the actual numbers, not the cherry-picked ones, not the ones that confirm what you already believe, the complete math on both sides, including the factors most comparison videos completely ignore. By the end of this, you'll know exactly which ones wins for your specific situation, because that is the only comparison that matters. My name is Yang and I cover crypto, investing, and personal finance on this channel. If you want breakdowns that give you the full picture instead of the comfortable one, subscribe and hit the like button. Let's run the numbers. Before we get into the math, we need to understand why this debate keeps going in circles. And the reason is psychological, not mathematical. Real estate has a perception advantage that stocks will never fully overcome. And it comes down to one word, tangibility. You can drive past your rental property, you can show it to your parents, you can point to it and say, I own that. There is something deeply human about owning physical land and physical structure. It feels permanent in a way that a brokerage account number on a screen simply does not. Stocks, on the other hand, feel abstract, volatile, disconnected from anything real. Even though you're buying fractional ownership in companies that employ thousands of people and generate billions in revenue, it feels like numbers on a screen. And when those numbers drop 30% in a bad quarter, the psychological pain is immediate and visceral in a way that a declining property value, which you can simply choose not to look up, is not. Here's the result. Most people overweight real estate emotionally and underweight it mathematically, or vice versa. Neither instinct is fully correct. So let's correct both, starting with the numbers. Let's go back to person A, the $50,000 down payment on a $250,000 rental property. The most common argument for real estate goes like this. Property values go up over time, you collect rent, and you're using leverage, the bank's money, to control a large asset with a small upfront investment. All of that is true, and all of that is incomplete. Now let's build out the real cost picture, because this is where the real estate math gets complicated fast. To break even before making a single dollar profit, this property needs to rent for $2,137 per month. In many US markets in 2026, that's achievable. In some, it isn't even close. Let's say it rents for $2,200. Your monthly cash flow is $63 per month on a $50,000 investment. 1.5% cash on cash return before your time, before the 11 p.m. maintenance call, before the tenant who stops paying in month 4. Now, here's where real estate bulls will push back, and they're right too, because cash flow is only one part of the return picture. The real wealth in real estate is built through appreciation, mortgage paydown, and leverage. That's a real number, and it's genuinely impressive. But now we need to run the same math on the other side. Person B, same $50,000, index fund tracking the S&P 500. The S&P 500 has delivered an average annual return of approximately 10.5% over the last 50 years, including dividends reinvested, including recessions, including crashes, including every correction that made people want to sell everything and put it in a savings account. $50,000 at 10.5% for 20 years, it's over $368,000. No tenants, no mortgage payments, no maintenance, no vacancy, no property manager taking 10%, no 11 p.m. phone calls. But wait, because this is where it gets really interesting. Person B didn't just invest $50,000 in stock. Person A was paying $1,330 per month in mortgage payments. Person B had no mortgage. What if Person B invested the equivalent of what Person A was spending on mortgage payments every month? It's over $1.4 million versus Person A's $390,000 in equity. Now, that comparison isn't perfectly fair because Person A was also collecting rent that offset the mortgage. But even accounting for the rental income and the leverage advantage, the stock market return at this timeline is difficult to argue against on pure math alone. Here's what most people don't realize, and this is genuinely the part that changes the analysis depending on who you are. Real estate has tax advantages that stocks simply don't. Depreciation. The IRS allows you to deduct the depreciation of your rental property over 27.5 years. Even while the property is appreciating in value, on a $250,000 property, that's approximately $9,090 per year in tax deductions against your rental income, effectively sheltering a significant portion of your cash flow from taxation. Stocks don't have anything equivalent to this. The closest comparison, tax loss harvesting, requires you to actually lose money first. Here's the analogy that makes this clear. Real estate is like running a small business, with all the upside and all the operational complexity that implies. Stocks are like being a silent partner in thousands of businesses simultaneously, with none of the day-to-day responsibility. Neither is inherently better. They're different instruments, and the right one depends on your resources, your skills, your temperament, and your timeline. Look, here's my honest answer after running all of this. The mathematical edge over long timelines with equivalent capital deployed generally favors stocks. The data is consistent across multiple studies going back decades. The S&P 500's long-term return, combined with the liquidity, accessibility, and zero active management requirement, makes it a more efficient wealth-building vehicle for the average investor. But real estate wins on leverage, and leverage is the single most powerful force in wealth building when used correctly. The ability to control a $250,000 asset with $50,000 and have a tenant effectively pay down your mortgage for you is a structural advantage that pure stock investing cannot replicate unless you're using margin, which introduces entirely different risks. Now, choose stocks if you want passive, hands-off wealth building. You're starting with less than $50,000. You value liquidity and flexibility. You don't want to be a landlord. Choose real estate if you have strong cash flow to cover carrying costs. Your local market has a favorable rent-to-price ratios. You understand property management or can afford it. You want leverage and tax shelter advantages. The real answer: both, in sequence. Start with stocks because the barrier to entry is zero and the compounding starts immediately. Build your position, use the liquidity and the returns to eventually fund a real estate down payment in a market with strong fundamentals. Then, let both engines run simultaneously. The wealthiest investors in the world don't choose between asset classes, they stack them. Here's the truth about this debate that nobody says out loud. The biggest financial mistake isn't choosing real estate over stocks or stocks over real estate. It's spending so much time analyzing the comparison that you never start either one. Analysis paralysis is the most expensive investment strategy there is, because while you're waiting for certainty, compounding is happening for everyone else. Both vehicles work, both have produced millionaires, both have produced cautionary tales. The variable that determines which camp you end up in isn't which asset class you chose. It's whether you started, stayed consistent, and let time do the heavy lifting. You now have the complete math, you have the framework, the only thing left is the decision. If this gave you the full picture you were looking for, hit the like button. It helps more people find this content. Subscribe for weekly breakdowns in investing, crypto, and real personal finance strategy, and drop a comment below. Are you team real estate, team stocks, or are you building both? Tell me where you are right now and what's your next move. I read every comment.